hi everyone. As those of you that have attended these webinars before will know, we will just wait a few minutes more while people are joining us before we will start. But welcome to the Agrarian Change Seminars. I think we can start now. So let me start by welcoming everyone, and that means everyone from across several continents and time zones, to this Agrarian Change webinar organized by the Journal of Agrarian Change and the Department of Development Studies at SOAS, University of London. I'm Jens Lerche from the Journal of Agrarian Change and from SOAS, and I will be chairing the session. I'm also joined by two Journal of Agrarian Change co-organizers, Shreya Sinha from Queen Mary, University of London, and Enrique Castagnon from UCL. They're hiding right now, as far as I can see, behind their names, but they are here. Today we have the pleasure of welcoming Madeleine Fairbairn of the University of California, Santa Cruz, as our speaker. Madeleine is a sociologist, an associate professor, and the Pepper Giberson Endowed Chair of Environmental Studies at the University of California. She works on the political economy of the global agri-food system. Within this field, there are several strands to her research, and one of them is the financial sector's growing interest in acquiring agricultural land. Her award-winning book, Fields of Gold, Financing the Global Land Rush, was published in 2020 by Cornell University Press, and it is open access. The title of Madeleine's talk today is Just Another Asset Class, transforming farmland into a financial asset class. Her presentation will be followed by a question and answer session. And the last thing for me to do before I hand over to Madeleine is to remind you that we are recording this session, and if you don't want to be recorded, simply don't use your audio and video, and you can find the full program of our webinar and seminar series on our website, Agrarian Questions. With that, let's start today's program. Madeleine, over to you for the next around 50 minutes.
All right, thank you. Let me share my screen. All right. Okay. Oops. Hold on one sec. Thank you very much for inviting me. Thank you to Journal of Agrarian Change and SOAS and Jens and Shreya and Enrique. It's really an honor to be here with you all. So I thought I would start today with Bill Gates, because why not? It's always a good place to start. In 2021, Land Report magazine surprised a lot of people by reporting that Bill Gates had become the #1 largest individual landowner in the US, with almost 270,000 acres to his name. A lot of really breathless reporting and commentary followed on this revelation, with people, of course, because it's Bill Gates, searching for all kinds of philanthropic or nefarious motives for why he might be buying all this farmland. But the truth was actually much more mundane. Buying farmland seems to have just been a completely run-of-the-mill investment decision made by his asset managers. Meanwhile, the giant pension fund, TIAA, has also been buying a lot of farmland. It began rapidly acquiring properties all over the globe in 2007, to the point where now, as of the end of 2020, it owns about 2.25 million acres globally, worth about $8 billion. In a newspaper interview, a TIAA executive explained the company's approach to farmland, comparing it to other alternative asset classes that have now become very mainstream. He said, "This is just another asset class that has the potential of going the route that real estate, private equity, hedge funds did in the past." Now, Gates and TIAA have been particularly aggressive in their farmland investments, but they're not at all alone. Over the last decade and a half, a lot of financial institutions have been adding farmland to their investment portfolios, including private equity funds, university endowments, private foundations, as well as just a lot of wealthy individual investors. And it's this trend of growing financial sector investment in farmland that's the subject of my talk today. I'm going to be telling you about some of the main arguments for my book, Fields of Gold, which, as Jens said, was published in 2020 and is open access. So if you're bored right now, you can just download it, email it to all your friends. The book asks first, why has farmland recently become so appealing to investors? And second, how is farmland being transformed into a new financial asset class? Despite the fact that this assetization process runs up against a lot of barriers. It runs into longstanding moral norms surrounding speculation. It runs into political concerns related to land as part of national territory and important for national sovereignty, and even against the materiality of the land itself. I'm going to talk about some of these sort of tensions inherent to the farmland investment industry, as well as the institutions, ideas, and narratives by which this nascent and emerging, rapidly professionalizing industry is seeking to overcome them. So I'm going to mostly give kind of a big picture overview of drawn from the arguments of the book. But at the end, in case you're bored of that sort of big picture, I'm also going to delve into a couple of case studies that I've been working on more recently with collaborators that look at how farmland investment is playing out in particular places on the ground in the US. And this will give me a chance to move past the sort of why and how questions and get into some of the implications and impacts of this. And I should say that, so the book it's based on research in the US and Brazil, but here I'm really going to be drawing from the US context for the purposes of this talk. So first of all, okay, why is this happening and why now? For one thing, we might think about how this trend fits into the broader processes of financialization and growing economic inequality that have characterized the last 4 or 5 decades. There are many intertwined and partially overlapping definitions of financialization, but economic sociologist Greta Krippner captures one really important aspect of this phenomenon when she defines it as the tendency for profit-making in the economy to occur increasingly through financial channels rather than through productive activities. And this shift, Krippner tells us, can be seen in both the ballooning profits of the financial sector relative to other sectors of the economy, those parts of the economy that are actually making commodities and trading them. And it can also be seen in the growing dependence of even regular non-financial companies on financial income in the form of things like interest payments and capital gains on portfolio investments. This growing prevalence of financial over productive profits, of course, is intimately connected with the drastic increase in income inequality in the US and elsewhere since the 1980s. As Thomas Piketty and his colleagues have shown, a prominent reason for this growing inequality is that the proportion of national income coming from returns to wealth is increasing relative to the proportion of national income earned through labor. In other words, those who make money simply because they already have money are winning out over those who make money by working. And land, as I don't need to tell all of you, comes into this picture of growing economic inequality because property is one of the major forms in which wealth is stored and can be made to produce financial income. It produces annual rent just by sitting there, and it produces capital gains over time by appreciating, what John Stuart Mill famously termed the unearned increment. So this trend of growing economic inequality can potentially fuel concentration of land ownership, and concentration of land ownership can potentially add fuel to this trend of growing inequality. So farmland is being added to the enormous arsenal of assets that is already regularly used to generate financial income. And here, I mean, not just by farmers themselves, who of course have always to some extent made speculative decisions based on the value of their own land, but by hedge funds and other financial institutions who 15 years ago would not have touched farmland with a 10-foot pole. Suddenly, we see a proliferation of graphics like this one from The Economist comparing farmland favorably to other more established asset classes. However, it's also important to note that this trend is not at all new or not entirely new. An increasing tendency to treat farmland as a source of financial returns was noted already in the late 1970s and early 1980s by Doreen Massey and by David Harvey. Harvey argued that we were then seeing a progression to a more truly capitalistic form of land ownership, in which the land becomes a form of fictitious capital, and the land market functions simply as a particular branch of the circulation of interest-bearing capital. Under such conditions, the land is treated as a pure financial asset, which is bought and sold according to the rent it yields. Like all such forms of fictitious capital, what is traded is a claim upon future revenues. So this tendency to treat farmland as though it were a pure financial asset, in Harvey's terms, did not come out of nowhere in 2008, but it was greatly accelerated in 2008 when the financial crisis sent investors searching for new outlets for their overaccumulated capital. Faced with rock bottom interest rates and plummeting stock prices, investors started to look for real assets that would produce a decent return and would not just suddenly evaporate like so many mortgage-backed securities. Timberland was one obvious option. Timberland has actually been the target of institutional investments since the 1980s in the US, making it a precursor in many ways to what's now happening with farmland. Timberland was sort of the lower hanging fruit for finance sector land acquisitions because it was owned in huge consolidated tracts by these very vertically integrated forest products companies. And because timberland is just less emotionally and politically fraught than farmland is. But in 2008, as investors are looking around for some real assets to invest in, timberland is not looking so hot because, of course, the collapse of the housing market had decimated demand for construction lumber. Farmland, on the other hand, was doing very, very well due to the food price crisis, sky-high agricultural commodity prices, and therefore very high farm incomes, and therefore rising land prices. So we start to see in 2008 some capital switching into farmland. My own research largely confirms that farmland is increasingly being subjected to the logic of the financialization era, in which it is treated primarily or to a large extent as a financial asset, meaning as a source of returns in the form of rent and capital gains, and only sort of secondarily as a productive asset with the capacity to generate income by growing agricultural commodities. In fact, even more so than the rental payments from farmland ownership, I found in my research that investors were really drawn largely to the capital gains from land appreciation over time. In the eyes of the investment community that I was interviewing, the returns to agricultural land are frequently classed into two categories. First, the income return, which is also sometimes referred to as the cash return or simply the yield, that comes from actually farming the land or from renting out the land to someone who farms it. So this is the money that the property is producing every year as a result of its productive use. And second, the capital gains that come from the land appreciating over time. This figure here shows the breakdown of returns between these two categories for one fairly typical Midwestern state, Iowa. And what you can see is that the income return, which is the line, is kind of pretty stagnant / slowly going down over time since the 1970s. The capital gains from land appreciation, on the other hand, which are these bars, are all over the place, obviously negative in some decades and absolutely huge in other years. And it was only in around 2007, 2008, after several years of these appreciation returns, these capital gains really far outpacing the cash returns from production or rent, that institutional investors started getting really interested in buying farmland. This is from my book, so I haven't updated this to the present, but I should. And this focus on the financial returns from land was very much reflected in my interview data as well. Farmland investment professionals stressed repeatedly that a lot of the draw was in the financial returns from owning farmland, not the productive returns from actually farming it. They said things like, our annualized return on farmland investments has been between 18 and 20%. This is like at the height of the boom. This is 2013 or 12, I think. That's made up of about 15% that's coming from land appreciation. I think it's lazy to only squeeze 5 or 6% off the appreciation side. I think it's not making appropriate buying decisions. On the cash return side, we come in at around 5%, sometimes a little more, sometimes a little less. So this US-based fund manager is expecting to get 15% return from land appreciation and 5% from farm income. So generally, this orientation, this was quite extreme. In the US, many were sort of closer to 50-50, but they absolutely would not be investing if it weren't for that appreciation return component. And particularly in developing countries, it was more common to see the appreciation part be much higher. More generally, this orientation toward land as just another source of financial returns is reflected in the way that investors speak about land. One thing that particularly struck me was how often my interview participants would compare farmland to other more standard financial assets. They routinely made comparisons like this. Geographically, among the commodity crop properties, the lowest risk would be in the Midwest. It's kind of the treasury bill of farmland. And statements like this are interesting to me because they take land, which is this heterogeneous amalgamation of soil and water and plant life and unruly microbes, and which is embedded in this web of relationships with tenants and farm workers and neighbors. And they reduce it essentially to its financial returns. They distill, or they attempt to distill, all this complexity into just another asset class. But of course, this is easier said than done. Farmland isn't just like treasury bills or stocks or even commercial office buildings. It is essential to human survival, to farmer livelihoods, and to cultural identities. Anyone who's read Polanyi, which I'm sure all of you have, knows that the commodification of land is always an arduous and highly contested process. And this is absolutely still true when it comes to taking land to these sort of even more advanced forms of commodification that are necessary to enable financial investment. Researchers have increasingly shown that farmland is not just automatically profitable or attractive or even comprehensible to the investment community. Instead, it must be rendered investable, as Tanya Lee puts it. She describes land as a complex assemblage of material and social qualities that varies across cultural contexts. She says, Clearly, assembling land as a resource available for some purposes to the exclusion of others requires a great deal of complex cultural work. It involves the deployment of technologies to make land productive, metrics to adjudicate between more and less efficient uses, and inscription devices that make land into a resource for different actors. Other scholars, such as Stefan Uma and Anna Visser, apply the concepts of asset making or assetization to describe the complex work that goes into transforming farmland into a suitable financial investment. To see these market-making practices in action, I spent, during the course of my research for this book, a lot of time at farmland investment conferences. Recently, a lot of researchers seem to be recognizing the value of such industry events as fieldwork sites, especially when an industry or a scientific field is still kind of just emerging. Such events provide a valuable opportunity to witness sector-defining activities as they take place, including moments of contradiction or contestation that arise and how they're negotiated by event participants. Agricultural investment conferences, many with a strong focus on farmland, began springing up around 2009 or 2010 and rapidly grew in popularity. For instance, one major conference series, Global Ag Investing, which these pictures are from, was first held in Manhattan in 2009 with 200 attendees. The same conference in 2010 had twice as many attendees, around 400. And by 2011, it was up to 600 attendees, had to move to a much larger venue, and had spawned offshoots events in London and Singapore. These events, which often have registration fees of around $1,000 a day, generally take place in lavish hotel ballrooms. They're in official presentations as well as over innumerable coffee breaks and cocktail hours. Farmland fund managers and operating company executives pitch the particular benefits of their own farmland investment strategy. Prospective investors learn about the benefits of buying fully functioning California almond orchards, or the profits to be made in acquiring undeveloped portions of Brazilian savanna and converting them to soy production, or about the fragmented farm properties of Romania and Bulgaria that are ripe for consolidation. These events allowed me to observe this nascent investment industry as it developed, watching in successive years as investment narratives were honed and the identity of the industry began to stabilize. And things did not always go smoothly. One of the main challenges that this emerging industry has had to grapple with in its attempts to render farmland investable has been the complex moral values with which farmland markets are imbued. In 2012, I emerged from an agricultural investment conference in New York with a group of attendees going to lunch to be loudly accosted by a group of protesters from Occupy Wall Street. Here's one of the flyers they were handing out. So they were handing out these flyers accusing the attendees of land grabbing. And this caused some kind of considerable angst within the conference. The woman in front of me in line to pick up her registration badge was anxiously asking the conference organizers to print out a new badge for her that didn't have her affiliation on it, because she worked for a very well-known private charitable foundation, and she didn't want it to be known by the protesters that her organization was there and sort of have them branded as affiliated with land grabbing. A few years later, a coherent campaign had materialized, led by several different family farm and environmental activist groups, particularly targeting TIAA as one of the most recognizable household names associated with this. This picture on the right is from a protest I attended in 2017 in front of TIAA's Manhattan headquarters. This retired college professor is herself a TIAA account holder, is giving a speech in which she rejects on moral grounds the very idea of her retirement savings generating income in a way that could lead to the dispossession of peasant or indigenous communities. Her speech and the movement as a whole challenges the view of farmland as just another asset class, which is so essential to the industry's market-making activities. Of course, economic and moral values are always intertwined, often to such an extent as to be functionally inseparable. But these moral and economic entanglements take a particular form when it comes to farmland markets. And one I should say that is, of course, can be very, very specific to different locations, different geographies, and also one that has changed considerably over time. In the US, the idea of investing pension fund money into farmland originally actually emerged in the 1970s, which was the last time that there was a massive run-up in farmland prices. You can see here, this was the most recent run-up in, or the run-up in farmland prices beginning around 2006, 2007. Here was the 1970s, big farmland boom, and then a big farmland bust beginning in the 1980s. In 1977, as farmland values were rising to dizzying new heights, representatives from Merrill Lynch and a Chicago bank proposed a new fund that they called Agland Trust, which would invest pension fund capital into farmland expressly for the purpose of cornering some of the profit from this dramatic land appreciation. This proposed fund, which is at the time was very novel, was a complete failure. The moral outrage at such an idea was so strong that a subcommittee of the House Committee on Agriculture held 3 days of hearings about it, at which almost 50 people gave statements, and none of them, other than the fund representatives themselves, had anything really good to say about this idea. In fact, in this day and age, this 400-page report from the hearings actually makes for quite sort of refreshing reading because it's so surprisingly bipartisan. Democrats and Republicans alike agreed that it would be wrong to allow pension funds to buy up farmland, possibly driving up land prices for farmers in the process. Their statements at the hearing reveal a shared belief about the appropriate scope of financial activity in agriculture. The role of finance, some of them argued, was to supply capital to producers, not to monopolize scarce productive assets themselves. So the sort of background to this is that in the US, some institutional investors, particularly life insurance companies and commercial banks, have actually long participated in farmland markets, but with a really key difference. Their involvement had, up to this point, been mostly limited to supplying mortgages to farmers. But now, with this proposal, institutional investors wanted to own the land themselves. Many subcommittee members were uncomfortable with this shift. They exhorted pension funds to stick with the historical precedent, expressing a view of land as first and foremost a productive asset which should be owned by those who use it in production. As one Republican representative put it, I respectfully suggest that if our nation's pension funds would like to invest in American agriculture, they should follow the example of the major insurance companies and make direct real estate loans to farmers at current rates of interest. The Agland Trust representatives, in turn, attempted to defend themselves by reframing their land purchases as effectively equivalent to loaning money to farmers. They argued that by removing the expensive burden of land ownership from farmers, they would in effect be freeing up working capital that the farmers could then use in production to expand their profits. This argument did not go over well. Another Republican representative summed up the general sentiment emphatically, saying, "There is nothing that lies so deep within the soul of a farmer as the desire to own his own land. I think that is really the crux of the matter and is why such an outpouring of sentiment has occurred. My suggestion would be that you go back to the drawing board and drop the idea. You really have been tinkering with the virtue of country America with this proposal." That Agland Trust is here construed as tinkering with America's virtue makes explicit what was implied throughout the hearing, that land ownership by financial institutions rather than farmers constitutes a moral threat. Its critics did not reject it on the grounds that it was illegal or unprofitable, but rather that it broke with traditional ideas about how the financial sector should behave in relationship to agriculture. And a few days after these hearings, the proposal for Agland Trust was withdrawn in defeat. This uproar over ag land trust can be understood with reference to what Mariana Mazzucato calls the production boundary, the sort of imaginary line that society draws between value-generating producers on the one hand and value-extracting non-producers on the other. The production boundary is discursively constructed, and its location has changed dramatically over time. At the Ag Land Trust hearing in 1977, we can still see a general sentiment that financiers are essentially non-productive actors whose only morally legitimate role is to support the real producers, farmers, by supplying them with capital. In the decades that followed this hearing in 1977, however, this changed enormously. And by the time the next farmland boom rolls around, circa 2008, the production boundary has been expanded, both in the popular imagination and in the actual calculation of metrics such as GDP, to encompass the provision of financial services as among productive activities. Mazzucato chronicles this very explicit in a lot of detail. However, the moral legitimacy gained by finance remains somewhat tenuous. Marieke de Good shows how finance reinvented itself over and over again over the course of the 20th century, removing itself from the morally tainted sphere of gambling to become productive and professional risk management experts. And yet, she points out that traces of the contingent discursive moves that legitimize speculation continue to haunt financial discourse today, especially in times of perceived crisis. Or I would add, especially when it comes to morally thorny commodities such as farmland. Farmland investors today must still work hard to shore up their precarious moral legitimacy. And I found that this work continues to hinge on their ability to identify themselves as productive actors. Though the production boundary has shifted considerably since the outcry over ag land trust in the 1970s, that shift is not definitive, and investors still perform discursive gymnastics to ensure that they are located on the producer side of that boundary. In particular, in my interviews, I noticed 3 common discursive moves undertaken by farmland investment professionals, also in their presentations and in their promotional materials. First, if the investment professional has any personal or professional connection to agriculture, that connection is stressed for everything it is worth. One farmland investment professional I interviewed, for instance, referred to himself repeatedly throughout the interview as a real farmer. Another boasted of his ability to drive a tractor and castrate a bull. Second, even those farmland investors with no hope of being viewed as farmers, who can't claim a grandfather who owned a farm, can still position themselves as essentially productive actors by emphasizing their improvements to the land. In true Lockean form, investment professionals implicitly justify their land ownership by stressing plans to transform their properties, generally bringing them to higher value and more intensive uses. And finally, like the Ag Land Trust representatives before them, today's farmland investment professionals still often frame their efforts as a means to support farmers. Like these advertising materials on the side here, from the Canadian farmland investment company Bonifield Financial, which buys land from farmers and then rents it back to them in the form of long-term leases. They stress how their land purchases free up operating capital for business expansion or allowing aging farmers to retire while also passing their farming operations, if not all the land, onto their children. Cumulatively, these discursive moves allow investors to sidestep the remaining stigma surrounding finance and rentier income more generally, and to bask instead in the warm moral glow associated with farming. However, the challenges of the new farmland investment industry do not stop here. At the same time as investors must work to create moral legitimacy around their own participation in land markets, they also face challenges inherent to the materiality of their investment object itself. So you all know that within the political economy of agriculture, there's this long line of theoretical reasoning dating back to Marx and Kautsky in the 19th century, which proposes that the peculiar physical nature of the agricultural production process, the need to work with land, with the seasons, with plant and animal biology, with weather, makes it harder for capitalist producers to profit from agriculture as compared to other industries, which in turn slightly protects peasant and family farmers from capitalist competition. However, it's also been widely observed that capitalist corporations have found many, many ways to profit from agriculture despite this awkward materiality. As George Henderson puts it, points out, finance capital in particular, as compared to industrial capital, can often find opportunities for profit in that awkward materiality itself. As he eloquently puts it, capital and nature are webs of constraint and confinement that must be carefully recast as fields of opportunity. The longer I spent doing this research, the more I came to see this as one of the central tensions of the farmland investment industry. The unruly materiality of farmland and agriculture continues to pose major challenges, but industry actors are also working diligently to find ways around those challenges so as to render land investable. Following sociologist Patrick Mooney, I'm going to refer to these efforts as detours. And I'll give you just 3 examples to show what I mean. There are a bunch more I could talk about, but these ones were kind of quick. One thing that sets land apart from other commodities is just how heterogeneous it is. 2 plots of land in different parts of the world will be quite unlike one another in terms of soil types, climate, land tenure arrangements, etc. And this lack of uniformity makes farmland very different from soy futures or other standard financial assets. And it poses a real problem for attracting non-specialist investors to the asset class. This has given rise to something of a cottage industry in generating new metrics and figures to help investors compare farmland across the globe. For instance, these 2 figures are from the London-based global real estate company Savills. And these are sort of 2 different approaches to commensurating the investment potential of farms in vastly different geographies. One over here is simply a visual representation of land price appreciation in different countries, while the other is a more advanced bid at commensuration, attempting to quantify the risks and benefits of farmland investment in different national contexts. What is striking about these metrics and images is usually just how low resolution they are. The unit of analysis is almost always at the country level. Despite the fact that countries, contain vast geographic and political and climatic diversity frequently. But of course, taking the complex and making it simple, taking this kind of immense qualitative variation and standardizing it in the form of a few quantitative indicators is precisely the point of commensuration. It's that simplification and standardization that gives commensurative images like this their power and their utility as decision-making tools. Another big problem with land is the way that it immobilizes capital. Because land itself is immobile, land markets tend to be relatively local and relatively illiquid, meaning that it's generally not quick to buy and sell land. And this is a big problem for many investors who are used to being able to buy and sell stocks on a dime. A detour around this obstacle has arrived in the form of the publicly traded farmland REIT, or real estate investment trust. These are essentially companies that own a bunch of farms, and investors can buy stock in those companies just like they would in any other company. And then the farms are all rented out, and the investors receive dividends based on the rental payments or sometimes the land appreciation after a land sale. This over here is the stock price movement for there were 3 US-based farmland REITs. One has gone out of business. There are now 2, and this is the stock price movement for one of them, the first one that came out. I think its IPO was in 2013, and it's called Gladstone Land. And so you can see that this is sort of what liquid land looks like. It's just bouncing around like any other stock. I think I took this about a month ago. And this is a major detour around the problematic materiality of land, because it not only makes farmland a liquid asset that can be bought and sold almost instantaneously, but it gets rid of the high upfront cost of acquiring land. Now, anyone who can afford to buy stocks, who has Robinhood downloaded on their phone, can invest in farmland for far less than it would cost to buy a single acre of land. This is also over here, this is a slightly different thing, and not in its present form quite as liquid as the public REITs, publicly traded REITs. But it's worth mentioning that there are also, starting in around 2018, there are all these new farmland crowdfunding platforms being introduced. And they're kind of just, many of them, right now, you generally have to be an accredited investor to invest in these. You have to have a bunch of money. And right now, most of them don't have a secondary market. So investors can't just easily get out of their investment and trade between each other. But most of them are working on that. So the idea is that you can buy a $10,000 share in an Illinois farm. And as soon as you want to, you can just sell it on the platform to someone else who wants to pick up your share. So it's sort of basically making it much easier to invest in farmland on the internet. Another major material difficulty of farmland investment is just the physical extensiveness of agricultural production. Farming operations are spread out over space, and this can create problems for actually knowing what's going on in your fields because you can't regularly visit and experience all of them. The development of precision agriculture since the 1990s has, of course, largely been an effort to address this problem on behalf of producers. But this problem reaches a whole new level as investors are amassing hundreds of thousands or even millions of acres of land, often widely distributed and likely very far away from their corporate headquarters in global financial centers. So as a result, we are now starting to see new ag data startups that are specifically marketing big data solutions for institutional farmland owners. At an ag tech conference I attended in 2017, a data analytics company presented which explicitly mentioned institutional investors as among the primary clientele for its farm management services. The presenter explained that if you think about old school family farming, so 4 or 5 generations ago, you had a handful of parcels. You could manage it on a napkin. When you get to tens to hundreds of parcels, you move into the Excel spreadsheet. But then when you get to hundreds to thousands of fields, sometimes they're spread across the entire country, sometimes even international, you now need something like artificial intelligence and machine learning. These types of big data startups are pushing up the upper limit of the number of farms that investors can profitably manage and the number of tenants they can effectively surveil. So I think that this is really a cutting edge of farmland asset making that is going to see a lot of movement in the next few years. So up to this point, I've basically argued that farmland is undergoing a process of financialization in which it is increasingly targeted by financial institutions, valued for its financial returns, and treated as a pure financial asset class. And I've also argued that this process is still incomplete and contested. It runs into all kinds of moral and political and material challenges, which this nascent farmland investment industry is working diligently to overcome. But even though this financialization of land is still really in its early stages in many ways and still incomplete, thank goodness, I want to argue that it is incredibly important to pay attention to because of its likely environmental and social consequences. I'm going to sort of shift gears now, partly because I want to talk about why this matters, and partly just to give you a break from this kind of bird's eye view, and tell you about some of the case study research that I've been doing more recently. I'm going to just talk about this very shallowly, but I'd be happy to talk more about it in the Q&A if you're interested. And my goal here is to really kind of illustrate some of the stakes of farmland financialization. So why does this trend matter? Why do I think this is such a big deal? First, because the particular mindset that investors bring to farmland investing has environmental consequences. Their laser focus on land appreciation means that they're always trying to bring land to higher value uses. This can, hypothetically and potentially, lead to environmentally positive outcomes, as in the case of Farmland LP, which says that its sort of investment thesis is that it achieves land appreciation by having the tenant farmers on its land bring properties through the time-consuming and difficult process of organic certification in the US, USDA organic certification, which leads the land to become much more valuable. But most of the time, this land appreciation is going to be achieved through an intensification of production, furthering the trajectory toward more input-dependent forms of production. The pursuit of land appreciation can also mean transforming farmland from a lower to a higher value use. This was the case in California's Cuyama Valley, where in 2014, the Harvard Management Company, which manages Harvard University's then, I think it's much more now, but then $40 billion endowment. Harvard Management Company purchased an 8,700 acre parcel of unirrigated rangeland and immediately began transforming several hundred acres of it into an irrigated vineyard. You can see in this picture the early vine plantings here, these little pinkish things. They're sort of wrapped in pink plastic against the backdrop of this parched mountain range. What was so striking about this case of Harvard Management Company investment in the Cuyama Valley was that they chose to create this irrigated vineyard in a place that was experiencing a water crisis. The Cuyama Valley gets just a few inches of rain per year in a normal year. It also has very little surface water. So all of the agricultural production already taking place in the valley, which is a lot. It's a major home to major organic vegetable growers. All of this existing agriculture is dependent on pumping groundwater, with the result that groundwater in this valley was already at the time of Harvard's investment being extracted at twice the rate of recharge. And the water table had been declining for years. So at the time of this land purchase, the water situation in the valley was already really unsustainable. You can see here the Cuyama Basin, the Cuyama Water Basin, on this map showing all the basins that the state of California deems to be in a state of critical overdraft. And here it is blown up, the basin, and you can see in green here is the property that Harvard Management Company bought through a couple of intermediaries. It was an asset management company named Grapevine Capital Partners that did most of it. But so in addition to this pre-existing state of a semi-arid valley with critically overdrafted groundwater, when this investment was made in 2014, California was also at the peak of its last drought. It had barely rained for years. And as a result, the state had been forced to pass for the first time in its history a comprehensive groundwater regulation, the Sustainable Groundwater Management Act, or SGMA, which mandated a local level process to create plans to sustainably manage groundwater extraction at the level of the basin. The most overdrafted basins, including Cuyama, had 5 years to make this plan and begin to implement it. So this moment, this window between the law being created, being crafted, and groundwater withdrawal limits actually starting to go into effect, is when Harvard buys this property and begins drilling wells. They essentially squeezed in under the wire, cornering a share of scarce groundwater resources before access was legally limited. And from the financialized logic of the farmland investor, this makes perfect sense because whereas large parcels of dry rangeland in the area generally sell for under $1,200 an acre, I think it's between $300 and $1,200 is what I've seen for that properties of that size. Vineyards in the region sell for $25,000 an acre or up to over $50,000 an acre. So they were really locking in water access and with it land appreciation. Here's one last picture of the valley with the vineyard, a more established part of vineyard off to the side here. This is just a tiny bit of it. It extends a long way. For me, this case illustrates that bringing land to its highest and best uses will often mean intensifying resource extraction. This is particularly striking in the case of Harvard Management Company, which wreathes itself in the language of sustainability and investing for the long term. This is a screen grab from their website. It appears, however, from this case that a sustainable long-term approach to farmland investing may mean profiting despite or even because of ongoing environmental harms, rather than actually working to counter those harms in any way. A second reason this trend of farmland financialization matters is that it will have major social consequences, essentially shaping who gets to be a farmer. In the US, there's already been this ongoing process over the last century of farm sector consolidation, where the number of farms has dropped precipitously since about the 1930s, and in parallel, the average farm size has grown. It seems likely that this consolidation will only be heightened as small and beginning farmers find themselves in competition for land with multi-billion-dollar investment funds. In fact, just last week, the New York Times ran an article pointing out that this was already happening, that farmers were being priced out as they found themselves in competition with deep-pocketed investors. But importantly, this process of farm sector consolidation also has a racial dimension to it, probably many racial dimensions, but I'm just going to talk about one of them. The number of Black farmers has dropped far more precipitously in the US than the number of white farmers. I didn't put the source here, but this is from a report by Data for Progress. This is because Black farmers have had to contend with all the same economic pressures as white farmers, but also with massive discrimination from the government in the provision of loans and services. Black farmers actually sued the USDA over this discrimination and won the largest class action settlement in US history in 1999. But for most farmers, this was too little, too late. The land was already gone. Black farmers in the US, mostly we're talking about the southeast of the US, are also greatly affected by a lack of legal protections for the collective land ownership form known as heirs property. Heirs property results from the fact that since the Civil War, many generations of Black farmland owners have died without wills. And when this happens, the land just sort of automatically passes on to all their heirs. So this leads to increasing fragmentation of ownership through the generations. By some estimates, about a third of Black-owned farmland in the Southeast is in the form of heirs property. In the absence of legal protections, this land is very vulnerable to predatory developers and real estate speculators, which can often force a sale of land by just convincing one of the heirs to sell. My PhD student, Elsa Calderon, and I, in collaboration with the National Family Farms Coalition and the Federation of Southern Cooperatives, have begun doing some research to try to understand how this pre-existing precarity of African-American land ownership may be interacting with growing investor appetite for land in the Mississippi Delta. The Delta is a region with a lot of Black farmers, and it's also an investment hotspot right now, in part actually because California is drying up. A lot of as California is increasingly drought-stricken and is having to limit groundwater withdrawals, people are starting to sometimes talk about the Mississippi Delta as the next California because it has such abundant water resources as well as fertile land and a lot of other good things about it, that people think that it could potentially become much bigger in specialty fruit and vegetable crop production. We're very in the middle of this research still, so I'm not going to say very much about it. So far, Elsa has been interviewing farmers in the Delta over the last 2 summers. I think she's interviewed about 40 people. And I've been doing some Zoom interviews with land investors and managers. And we've both been spending a bunch of time looking at assessors' parcel data to try to figure out who actually owns the LLCs that appear in this data, what investors are behind it. What's immediately clear, again, we're not very far along, but what's immediately clear is that investors are everywhere in the Delta. These are just two maps that ELSA has made based on our parsing of the assessor's parcel data. And you can see from, I don't know if you can see, it's kind of small, but all the big institutional investors are there. You've got, like, for instance, here in Bolivar County, Bolivar, I'm supposed to say, Bolivar County, Mississippi. These blue ones are owned by TIAA. They're managed by Westchester, who manages their farm properties in the name of a couple of different subsidiaries. You've got Manulife Investment Management here in orange, which is formerly Hancock Agricultural Investment Group. You've got UBS, it's another big one. And there are also some of the newer and smaller ones. Acre Trader, that one of those crowdfunding platforms, is here. Oops, where is that one? I'm not sure. I think that's just these little ones. Farmland Partners, one of the big real estate investment trusts, is in the Delta. Bill Gates, Oak River Farms, which is affiliated with Bill Gates, is here. And almost all of these properties have been purchased within the last 15 years. So it's really developing fast. It's still early to really know what our findings are from this research, but so far our research suggests that these big investors are probably not targeting small African-American landowners for land purchases. That was sort of one of the questions that the organizations that we collaborate with had. They're not, it seems, probably going after heirs property owners, for instance, as some of the smaller real estate companies have done. Instead, they're more likely to be buying really large properties that are disproportionately owned by white farmers. But they may nonetheless be having an impact on farmland access for Black farmers. For instance, one county official whose job it is to work with land records explained to ELSA, a good bit of the Mississippi land in this area that's sold recently has been bought by investment firms. Most of them are out of state. One of the larger ones that we see is from Colorado, and they're buying land and they're paying money that the local farmers can never even think about paying. Land has gone from being $2,000 an acre to right now, it's bringing $5,000 an acre just in the past few years. The local farmer, the family farmer, is just being priced out, but these investment firms are purchasing it, and then the rent is going way up right now. So just the presence of all of these big investors in the region may, at least in the view of this official, and we heard this from some farmers as well, be driving up land values and also possibly driving up rents. There's also the question of tenant selection, which we don't have too much data on yet, but from my own research, listening to a lot of presentations from the investment community, investors often talk about how they select only the most professional tenants, how they like to have a few tenants managing a lot of their properties. So it's also very possible that the sort of selection of tenants is going to be biased towards the largest, most capital-intensive producers who can farm a lot of their properties. Okay, so I'm going to stop here. I hope these cases have illustrated why this phenomenon of farmland investment is so important to monitor and to understand. In the future, I think it could potentially play a huge role in shaping both how land is farmed and also, again, who gets to farm it. So I'll stop there and take questions. Thank you.
Thanks so much, Madeleine. That was really, really interesting and full of information, certainly for me, that I was unaware of. So so we are indeed going on to questions and answers now. And if I should just to try to pick that off a bit, so what this reminds me of, or what I see as quite parallel to this maybe, is the way other aspects of agriculture is being turned into financial assets. I'm here thinking of the future markets for agricultural commodities, which has by now such a big impact on the actual prices for farmers producing produce. So where, again, it's nothing to do with the actual values of the produce, but it's to do with the market for investment, and that seems to be the same here. So I think that's really interesting to get on the table. So my first question is really, so if you compare this, this drive to turn agriculture to turn land into financial assets and investment by institutional investors and private equity firms and so on, to the period of land grabs that was so much highlighted around the same time as where your work started, around so after the agricultural crisis in 2008, after the price spike. So is this the same? Is this an aspect of that, or are we talking about two different, conceptually different processes here?
Sorry, Madeleine, can you stop sharing your screen? Then people can see you.
Yeah, that'd be nice.
Sorry.
So that is certainly one question. Another one is, have you got an idea of how important this land market is, in the sense of how much land has been taken over through this in the US or even globally? So that would also be very interesting, just to get an idea. I take that it works, that it has impacts way beyond the argument that it has impacts way beyond what is taken over, because it squeezes, it leads to price increases. So it matters more than the actual percentage, but it would nevertheless be interesting to get an idea of that percentage, I think. And last question. Yes, so farm land prices are being increased because of this, but won't this be an issue of boom and bust? Because if the land price increases mainly as a speculative process, is it possible that it can go on doing that in spite of the fairly stable income from the land that you also showed before? So these are some of the questions that your presentation raised to me, and you don't have to answer all of them, but if so pick whatever you would like to address now, and we might return to some of these questions through others as well.
Okay. Hold on, let me just make sure I've got everything. Okay. Okay, I'm going to say right off the bat, I'm going to disappoint you on question number 2, because I knew that I should refresh myself on those figures before coming here, and then I ran out of time and I didn't. But the answer is it's not huge. I really don't know. A few years ago, the upper estimate I saw was like $40 billion worth of institutional capital in global land markets. But now I just recently saw a higher estimate from an industry report, but I can't remember what it was. I think the really key thing about that is that it's like a number, let's just say 40 billion for now. What that means is so relative, like $40 billion to the financial sector. In my book, I talk about how at the time I was researching the book, I was at an investment conference and I was sitting next to this very talkative hedge fund manager. And she was at this agricultural investment conference just to check it out, just to like see what was going on. And she was like, yeah, I just really want to know what all the buzz is about. And she said, the amount of capital that's actually invested in this right now is mouse nuts. And I looked at her like, what? And so like mouse nuts. And to clarify, she said, it's spit. And I just thought, wow, it's so like to financiers, tens of billions of dollars is spit. But when that is put into play in like potentially relatively concentrated geographic areas within particular countries, it I mean, compared to the amount of capital farmers are used to working with, it's just unfathomable. Like, you can't even imagine $1 billion, right? And it has the potential to kind of create real impacts. So I'm not sure how to sort of theorize that difference, but I think it's just really striking how, I guess, like another example would be, for an entity like TIAA, which has so much capital in land, has $8 billion worth of land globally. They have something, last I checked, it was like $1.3 trillion in assets under management. So this is like less than 0.5% of their investment portfolio invested in farmland, but it buys so much land. It buys millions of acres of land. So just kind of highlighting that what doesn't seem like much money to the financial sector is a ton of money. In the US, I can't remember, I'm not gonna venture. There are certain states that are very well documented what percentage of, like Iowa does a regular land survey, and the USDA has certain surveys that estimate the amount of land that's owned by investors, but they sort of don't differentiate very well, like whether it's just like one individual who owns one property versus a giant financial institution. The best source of data is the National Council of Real Estate Investment Fiduciaries, which is this real estate entity that has a farmland index specifically gathering data from these big financial institutions in the US. But even they don't have a comprehensive idea of how much land is owned by investors. So basically, nobody knows. The other two questions, the land grab question, I would say, I very much think of it as part of the same phenomenon. I was completely, this grew out of my dissertation research. As a PhD student, I was kind of awed by, seeing this land grab unfold, and was figuring out a dissertation topic, and was sort of searching for something I could do that would contribute to this, a lot of very rich research by people who were sort of documenting land acquisitions occurring, land grabs happening in their long-term field sites and things like that. And what drew me to this aspect, to particularly the role of the financial sector in this land grab, and I should say, I refer to it in the book as a global land rush for various reasons, one of which is just that, all of these asset managers and investors were my research participants, and I just felt a certain discomfort with I also interviewed a lot of activists and things, but I felt that I should use the same language in describing my research project to the different people I was interviewing. And I just felt kind of uncomfortable referring to them as land grabbers behind their back. Whereas I felt comfortable saying that there was a land rush, that there was a land boom, I'm not sure if that's a good reason or not. But also I think that I wanted to make clear that, especially in this context, there's no element of illegality. It is very, it's extremely like legally sanctioned. And I like it. I think it's very descriptive. But the reason I was drawn to the role of the financial sector in all of this was, I wasn't seeing as much research on it at the time. There has been a lot of great research coming out more recently. But I think that what I think is interesting about it is it sort of forces you away from really overemphasizing the role of states, the role of security motives, or the role of north-south investments. And not to say that all of that isn't a very major aspect of the land grab phenomenon, but it kind of highlights similarities. It highlights sort of things that are happening in the same ways in a lot of different countries, including that there are elements of this land grab or land rush happening in the US as well. And it highlights that it isn't just something that's kind of happening in the global South. It's also something that's happening in the global North. And okay, the question of will this just be an issue of boom or bust, I think is very interesting and very important. What I really found in my research, and I'm glad you asked, because this is one of these cases where there's something else I wanted to say that I didn't get to. What was really striking in my historical research about the US, I sort of did a bit of a deep dive into the development, the sort of trajectory of institutional investment in farmland in the US, going back to all these mortgage, farm mortgage lending by life insurance companies and things, going way back. And what was really striking to me was every time there is a big farmland boom in the US, in the 1910s, there was a big boom associated with World War I, and then again in the 1970s. And during those moments, there would be these shifting dynamics. In both of those times, institutional investors started getting interested in having equity investments in land. But then there was a bust. But those institutional shifts that happened in those moments left traces and sort of built groundwork. And they created new professionals. They created new farmland investment professionals who then lived on, and continued working. So for instance, in the 1970s, we had this big boom and then this big bust. And during the boom, there started to be some efforts like Agrarian Trust. Also, some of the life insurance companies made some equity investments in land, which they got away with because they were known to be farmland investors. But what really happened was when the boom ended at the beginning of the 1980s, when we had this huge farm crisis in the US, there was the Volcker shock. Everyone's who's in debt is in lots of trouble, including all US farmers. And there's this huge crisis. And also, interest rates going up is terrible for farmland values by itself. And inflation is great for farmland values. So inflation going down, bad for farmland values. So the boom ends in complete bust in the early 80s. And all these farmers are foreclosed upon by the life insurance companies that own their land. And these life insurance companies, inadvertently, sort of not intentionally and not desiring it, except that it's part of their business model, but they end up with all these foreclosed farms on their books, and they are forced because of this to develop in-house farm management capacity. So what happened was that in the 1980s, and then farmland values really lousy for a while, but the actual professionals that learned how to manage farms on behalf of institutional investors as a result of the farm crisis became the founders. They spun off these asset management companies that became the first major sort of professional farmland asset management companies, farmland focused asset management companies that laid the whole groundwork for the 2008 booms. Those were the companies that were there ready and waiting. If you look at those companies that were on that, that Mississippi map, it's like Manulife, which owned Hancock, and it's Prudential is another really big one, and UBS, and they're these financial institutions because it was that bust that built the management capacity and the professional knowledge that then was ready and waiting to just explode onto the scene in the early 2000s when farmland values began to go up again. So what really became clear to me was, I'm giving a very long-winded answer. I swear it's really interesting. What really became clear to me was that there may be busts and there are busts, but it's this is quite a pessimistic answer, actually, I guess. There's it's cumulative, and it is building, and that knowledge and that there's no unseeing farmland as a financial asset. That has been broken up. That's a thing now. There's no going back to the 1970s when Agrarian Trust was morally unthinkable. It's thinkable now. TIAA puts out reports about explicitly saying that it's sort of facilitating the separation of farming from ownership of the asset base or the land base. I can't remember how they say it exactly, but they're touting this. And so, yeah, I don't know if a bust, their values did stagnate from about 2011 or 2014 or so. US farmland values really stagnated until 2021 when they really started to go up a lot again. And the industry didn't disappear,
Thanks. No, that makes total sense. And yes, it is scary, as you say. So we have a couple of participants that have raised their hands, which is, of course, the way to mark that you would like to raise a question. So please continue to do so. You can also put questions in the chat. Simply write them out there if you prefer that, and we will come to them as well. But for now, let's go to Carla Gass. Carla? What happened? Carla disappeared somehow. So let us then...
No, I'm here.
Okay.
Sorry. I had difficulty in opening my unmuting me. Thanks, Madeleine, for such a very interesting presentation. I have two questions. Have you worked, or in your research, have you identified funds that have moved from only being interested in farmland to be interested also in farm operation, because the pursuing of the farmland valorization, there are many investors that want not only to, some decide to lend out the land and for other farmers to do such thing, and others, they decide to have the farm operation in their hands and high managers and so on. And this was one of the questions. And the other is perhaps following the question of Jens on future markets, and which is the I was wondering what you're observing there, because one of the things that I found in the first case, when institutional investors, for example, directly invest for example, in buying shares of a company, and when they do so, the company starts, at least in the southern corner of Latin America, the companies have started to buy a lot of land when these financial investors enters the company. And on the other hand, I am not sure what that means, and because but I've also been observing that in the case of Argentina, many large agribusiness producers have been able to open some kind of offshore companies to be able to bypass certain regulations, just to say it in a simple way, on market prices. And I was wondering if in which extent I could think of this, and that is to bypass, and two things: to bypass regulations on the price, to bypass taxes on export, and to be able to put money outside the country with all the problems that Argentina has with its exchange rate, right? So I was afraid, I was not sure if I could think of this as a part of financialization. I would like to hear your take on that. Thanks.
Thanks, Carla, and also for sharing what is effectively parts of your own research here, which is great. Thanks. Madeleine.
Yeah. Should I start with? The first question about whether I've seen companies move from that sort of own lease out model where they own the land, they're renting it to someone, to owning and operating. I'm not thinking of examples of companies that I've known specifically to do that. There are, of course, many companies using both strategies. So I would classify those as, and particularly in Brazil, you see a lot of cases where the operating company is the investment vehicle, yeah, and so I'm sure this is sort of the same in Argentina, and it's actually like some of the same actors between the two countries. So what I would just say about that is that there are different kind of risk return profiles associated with those two strategies, where if you're, so there are I should say, when I talk about this, I tend to kind of I'm like, investors do this and investors do that, but it's actually a very diverse field of actors, right? Different types of financial entities have very different profiles of how much risk they're willing to take on, how much return they're expecting to get for their investment. And they may even have different legal responsibilities, like, fiduciary duty, or depending what kind of entity they are, they may have different restrictions on sort of how much risk they're allowed to take on. And so these different types of investors gravitate toward different types of investments, like obviously, the ones that are wanting lower risk and are willing to accept a lower return are more likely to invest in really established markets there, rather than, in the global South or in sort of they're also more likely to buy established farmland rather than buying, properties that are, say, pasture that needs to be transformed into operating farms. They're less likely to sort of explicitly have that development aspect, transformation aspect. And I would say that they're more likely to adopt that own lease out model, where they just own the land and they're willing to just collect the rent, which is less, I would say, less risky in many ways than operating the farm yourself, but also potentially less profitable. So I would just kind of say that it depends on the profile of the investor and what kind of investor it is. But many do think that operating the land is essential. And I have had people say that to me in interviews, that they explicitly choose to operate the land themselves, or have a stake in the operation themselves, both because it means higher returns, but also because it gives them greater control over ensuring that the land value will go up, because they can ensure really high yields, or, they can really control it for the purposes of appreciation. So that's all the thoughts I have on that one. In terms of the sort of accounting shenanigans, that's so fascinating, and I'm very excited to read about it. So things that come to mind, is it financialization? I would say yes. I mean, financialization has a lot of different aspects to it, right? And there is a literature, gosh, I want to say, I feel like Dobbin is one of the authors. There's an article that literally, I think, has the term accounting shenanigans maybe in the title. It's sort of in the era of like Enron and stuff. There were a bunch of articles sort of about these kind of accounting maneuvers that as like one aspect of the financialization. There's probably some like better, more specific concepts though to talk about that. The thing that really resonates for me about that is the research that I did in Brazil, I chose to do research in Brazil partly because it seemed like such an interesting case to me, because they enacted in 2010, the outgoing Lula administration enacted, or his sort of attorney general put into place these restrictions on foreign land ownership, or sort of revived these restrictions on foreign land ownership. And I was very interested in going down there to sort of understand the politics around this and kind of interview people on both sides. And a huge part of what I ended up doing was having interviews with all these fund managers and also operating company executives who were just like, well, the first time I went down, sort of 2011, were complaining about it a lot. But by 2012, were just kind of telling me all the ways that they had devised to get around this. And it was really quite striking how I sort of attribute it to the fact that the sort of idea of the foreigner is like really not, it doesn't really work for regulating financialization. It doesn't really work for regulating these financial entities that are sometimes publicly traded, like their ownership is constantly changing and the nationality of their ownership is constantly changing. They're sometimes, they're like based in Luxembourg, or, they're just completely, their nationality is so slippery and so changeable. And I saw things like, I really want to share a slide, but I'm not going to. Companies just doing simple maneuvers like in the Brazilian law, they had to be have, and this has now changed in the last couple of years, but they had to have, I'm sure you probably know all this, 50% Brazilian capital was sort of the definition for being a Brazilian company under this reinstated regulation. And these companies pretty quickly realized that they could just do things like just create a subsidiary and just sort of shuffle their assets between two subsidiaries or between the subsidiary and the parent company, and just make sure that in that subsidiary, whichever subsidiary it was that was going to buy properties, just the capital behind that subsidiary was at least 50% Brazilian. Didn't matter if then the property like gets passed to a parent company that's 98% foreign capital, you know? So just that really opened my eyes to like how slippery, you know, these flows of capital, slippery sounds very derogatory, how extremely mobile and sort of fungible capital is. And it sounds like you know of a lot of different ways in which that happens.
Thanks.
So I have 6 people on the list, which is great. It also means that in order to get through that in 15 to 20 minutes, we probably should take at least 2 speakers or two questions at the time. So let me go to Julia first, and then Muskan afterwards.
Great. Thank you so much, Madeleine. I found that fascinating. So I have a question which is in some ways similar to Carla's, but I wanted to ask kind of specifically about the case studies that you're working on, and a potential link to my research. So I'm doing research in an area which is around a big plantation which owns some land, but most of its farming is done on a contract farming model where, you know, landowners around will kind of contract their land to produce for that factory. And that has obviously some really complicated economic effects around things like concentrating control over land. This is in Uganda. So it's also a place like what you were saying about the kind of southeastern United States, where there's a lot of kind of overlapping rights to land. So you get the effect of kind of concentrating control, reducing food crops. And obviously this is in itself a really complicated kind of socio-technical arrangement. But I wanted to ask whether you had seen interaction between other kinds of models of industrial farming and the financialization technology. Because in this particular case, it really seems to me that the way that this contract farming is set up is that the person who is registered as the owner of the land gets a payment when the crop is harvested from the company, but actually doesn't control much of what's done with the land. So it's effectively land hire. Mm-hmm. And I guess the question is largely, are companies kind of looking for that kind of, are companies, international investment companies looking for this kind of situation where it's kind of halfway there and that it would be easy for them to push it the whole way and make this a kind of international financial asset?
A very interesting question, because who is it that what is it they buy, which of course you did touch upon, Madeleine, but very interesting to get more into that as well. Muskan, your question as well.
Hello, I just wanted to ask about the fact that a lot of the farms, if they transition from being owned by small farmers to, you know, the large financial firms, and because they're so concerned with the value of the land and not just the, you know, current like productive value, would it be harder to like regulate them? So for example, the California, the Sigma thing with the, you know, irrigation or something, that obviously if you have restrictions on irrigation, it would devalue your land so much. But then because, you know, the financial sector is so notoriously hard to regulate because they're a lot richer, a lot more powerful, have a lot more, you know, political connections that way. Would that have implications for them for being a lot harder to regulate in terms of, you know, any kind of environmental policy or, you know, sustainable farming policies? And then in the future you'd have, so for example, in California, if like the Sigma policy thing wasn't put in place, and then you'd have, you know, a lot more, you know, drought risk and all those kind of things in the future. Are there implications of that, or has that already happened? Whereas there's been some kind of potential regulation that's been stopped or been a lot harder because it's a lot easier to regulate small farmers than large financial firms.
Mm-hmm.
Thank you.
All right.
Madeleine?
Okay, the first one, Julia, that's a great question. I'm going to be very quick though, because I don't know. And it's just very interesting. And that sort of like contract farming connection was very in my head when I began doing this research, because I'd been reading like in all my classes about contract farming. It's sort of like, oh, these companies don't want to own the land. They want to like put all the risk on farmers, but own everything else. Like get all the benefits, but none of the risk. And then it seemed very strange to me that now they're moving into, they actually do want to own the land now. But it actually, yeah, it's not something that I've had that I can think of a lot of examples of. But it is something I should really keep in mind, actually. I appreciate you putting that on my radar again, because contract production is huge in the South, especially like broiler production, broiler chicken production, and yeah, especially livestock. Yeah, and so I really wonder that. That's a great question. And then, okay, are financial actors harder to regulate in environmental situations? So in that California example, for instance, with Sigma, that was, I kind of came at it almost from the opposite perspective, where I had been reading of kind of assuming that they would be regulated, right? Where, a lot of the things that I have read in my life, or a lot of stuff that's been written about finance, is about how it, because investors are usually buying these liquid assets, they have a different kind of relationship to natural risk. There's like Lee Johnson's fabulous work on like catastrophe bonds and things like that, or work on, weather derivatives, and or just even, Jennifer Clapp and people writing about agricultural commodity trading. There's this sort of image of the financial sector as, through these very liquid types of investments, really exceptionally good at taking natural uncertainty or regulatory uncertainty and turning it into commodifiable risk, and making a bundle of money off it. And so I was really interested, coming from thinking about that work, in sort of like what happens now. We know that they're good at turning the risks of climate change into financial assets and profiting from them. But what happens when they're buying this kind of, Lee Johnson, in one of her pieces, talks about specifically how investors are good at taking the place-based physical vulnerabilities, she says, the place-based physical vulnerabilities associated with climate change, and transforming them into financial assets that investors can profit from. And I thought, isn't it kind of weird and paradoxical that they're buying this farm? They're like buying place-based physical vulnerabilities intentionally in this, drought-ravaged place, in a place where this new environmental legislation is pending, and who knows what's going to happen. They could get, the local, this newly created local board, like nothing has happened with this legislation. This new local agency could say that they can't have any water, right? And so I kind of thought like, wow, this is going to be really interesting to see how these investors cope when their sort of traditional strategies for dealing with uncertainty, I may be using uncertainty and risk overly interchangeably here. I'm sorry for people who are sticklers about that. How they sort of cope with that. And what I found was, what was sort of through the course of that field work was, maybe as your question predicts, they could really kind of throw their weight around as a $40 billion, or an entity backed by a $40 billion investment institution. It wasn't actually Harvard Management Company doing this. It was more the asset management firm that ran the investment. But they were showing up at the meetings about where the new water regulations were being made. They were hiring their own hydrologists to conduct their own water related studies that would try to sort of contribute evidence for why they should be allowed to draw the water table down much lower in their part of the water basin than the environmental consultants originally suggested. At first, they tried to just have their entire part of the water basin removed from the basin so that they wouldn't have to be regulated. They brought all this hydrological data to bear to try to convince regulators that they shouldn't actually be part of it. They were hiring lawyers to make, various different cases relating to sort of groundwater. And it was just really like a show of force in certain ways to just see what you can do, even faced with all this regulatory uncertainty and all this climatic uncertainty. It was quite impressive the ways that they were able to just really actively intervene and work to ensure that they would get the water they needed to make their land profitable. So I wouldn't say that they weren't at all like evading regulations, but they were certainly working to take a very active role in influencing the discussions. And so that's the only case that I'm really intimately familiar with, the details of how investors have interacted with a particular environmental regulation. But I would assume that that's something like, that they are often going to be the more powerful actors than their small neighbors who and may have more ability to influence the way things turn out.
Thanks so much. And thanks for these proper answers, even if sometimes it is I don't know. That is because that really strengthens the discussion. I think we will simply go to the last 4 people who put their hands up now, and then because we should try and finish around 7 o'clock UK time. I know people have other things to do, of course, after this. So I will go straight to Steve first.
Thank you very much indeed. Most interesting. There is a huge global agricultural mechanization industry, and that feeds into your discussion. And I was wondering whether you've observed an overlinking between that industry and the research they do in the public and the private sector.
That was a short and clear question. Thanks. Judith. You're still on mute. You're still mute, I think.
Okay, thank you. Thank you for a very fascinating presentation. I think that was opening up a huge territory for people like me who don't know enough about all this. I have 2 questions. One is, do you have a sense of the parts of the world in which this financialization is less successful or less attractive to these big investment organizations? Because I just wonder about if you could say anything about Africa in general, or about India, or about any countries that are able to resist this better, perhaps. And the other thing I would be very interested to hear a bit more about, you said that one of the rationales that was being given was that they would buy the land and then they would rent it back to the farmers. Do you have much sense of the degree of control or the sort of relationships between the people whom they're renting back to, and how far they're trying to control what they do, or they're just letting them be? I was sort of thinking about landlord-tenant relationships there that sounded as though they might be quite interesting. Thank you.
Indeed, yes, thanks. Chris.
Thank you. You focused, Madeleine, thank you very much for the presentation. You focused very much on the US case, and I want to bring a bit more the international dimension, which already came up in some of the questions and few answers to it. But because one key aspect, of course, of this whole financialization of land is to, as you mentioned, to make land liquid. And in this, the neoliberal policy is actually crucial. There was a whole World Bank program during the 80s and 90s and so on to property rights, financing property rights and registering land and so on. So for that, particularly in the case of Latin America, you need first to have property rights, and you have a legal system which gives security to the investor and so on, to the person who buys and so on, and a judicial system which is a conflict to be able to resolve and so on. So all these are also preconditions to make the land liquid. And you referred already a bit to Brazil. Investing companies, of course, don't focus on one country, particularly if you're from the US, and the dollar is a dominant currency. You can buy the whole world if you want, like the Chinese are trying to do sometimes. So my question comes, do you have examples of how these companies that you mentioned, that some of them are moving into other, like African countries, or in my particular case, in the case of Latin America, because from what I know, is as in Latin America has been mainly Latin American companies. For example, Brazilian capital, Argentinian capital, Chilean capital, who have invested in other Latin American countries also, mainly forestry companies and so on. So I wonder to what extent some of your companies that you mentioned also are beginning to invest in Latin America.
Thanks, Chris, and that goes nicely with Judy's question, of course. Shreya, last question for you.
Thanks, Jens, for squeezing me in. I have a quick question. Thanks, Madeleine. That was really interesting. So I know that, like during the talk, you said you made a strong case for why we should monitor these kinds of investments. But I was wondering, in addition to monitoring, I didn't get a sense from your talk about what kind of what can stop it? So one can monitor. Is there anything that can stop it at all? Is there any kind of, because so much of this is legal and so on. And if not, it made me wonder if this is it's not just another financial asset, or it's perhaps an asset par excellence, because despite all the questions of moral legitimacy and material complications, it seems like if they want to do it, they can just power through. So I would love to hear your thoughts on that. Thanks.
Fantastic. And Madeleine, that gives you 1 minute for each person who raised the question, which of course is impossible, but we should try not to run over too much.
Okay, I'll do a couple really fast. The link to ag mechanization industry, yes, absolutely. And some funds very explicitly highlight. It's interesting because now I'm actually doing some research on the agri-food tech sector in Silicon Valley. So watching lots of ag tech pitches and stuff, and there are a lot of interesting differences between like a farmland investment pitch and an ag tech pitch. But some of these funds do kind of explicitly highlight just how tech forward they are. Like I interviewed one who really highlighted as part of his sort of investment pitch that his partner was very embedded with ag tech stuff in Silicon Valley, and that they would be adopting new technologies constantly in order to have the highest yields possible. Also, there's just interesting relationships there, because I think that there's possibly been some sort of switching of capital from farmland investment to ag tech investment in the last few years. I'm not really sure because I haven't been to as many agricultural investment conferences recently, but I think that it would not be as farmland focused now as it was a few years ago. So that's just a couple of thoughts about that. The questions about where sort of different parts of the world where these investors are investing. So I would stress that, I was kind of disproportionately focused on, I think because of the sort of sites where I was going to a lot of these investment conferences, the investment community I was focusing on was more Western investors. They were primarily North American and European investors. So I think it would be quite different. I went to one investment conference in Abu Dhabi, and there was like quite a different, there was a lot more investments in Africa going on, and just there are very different cultures of finance, I should stress. And so I am kind of giving a partial view. The investors that I was that I did focus on tended to invest in certain parts of the world, which were particularly, I would say, North America, Brazil and Argentina, mostly Brazil, maybe a bit in Chile. There was like some Chilean orchards and things represented, Australia, New Zealand, and a little bit Eastern Europe kind of would show up sometimes, and not. I mean, I did interview people who were investing in Africa. It was a minority of investors that I interviewed, and tended to be more kind of hedge funds, more folks who were, not the pension funds. When we're talking about this sort of diversity of actors, more the folks who are looking for high returns and willing to take on more risk. In terms of, who's active in Latin America, I'm very out of date in my, I haven't been doing this research in Brazil for a decade at this point, so my information is out of date compared to, I'm sure, yours. But I would say that yes, there is a lot of like Argentinian capital active in Brazil, but there's also, there are companies like Brookfield, the Canadian real estate fund. There are publicly traded operating companies like Attico Agro that's U.S. controlled. And there are, all of these publicly listed operating companies like SCLC are themselves have investors, they have investors from other parts of the world. So yeah, so it's a mix. Landlord-tenant relationships, I think, is such an important question, and it's actually one that I would really like to explore. I've done a little bit of interviewing recently around this topic, but it's not something I know the answer to yet. And it's something that really, like, my research sort of points me in that direction. That I would say these two questions, the question of landlord-tenant relationships and sort of how this is experienced by the farmers themselves, and this question of the sort of policy, the sort of policy question of like, what do we do about this, are two areas that I think where my book just doesn't go, and where I wish it did. And I would really like to know the answers. The landlord-tenant relationships, I mean, yeah, I'm not going to say, I think my sort of hunch is that, and sort of anecdotally, I've heard a little bit, definitely that with some of these companies, there can be a loss of autonomy because of the sort of focus on land appreciation through intensification of production, or through even something like farmland LP, bringing the land into organic production. But I don't know, but I with some of the interviews, I did some interviews a couple of years ago, or a year ago, that I still haven't done anything with farmland access professionals, who were pointing out that, for some farmers, that might not be a bad thing. For some farmers, having a financial landlord who is in a distant city might be a lot better than the alternative. Like some young or beginning farmers, the alternative being like it being their aunt who's like constantly surveilling them, or their uncle, So I don't want to assume that I know that this is 100% a negative for farmers, or 100% stripping them of autonomy. And on the question, I think this is a good last question, the question of sort of what can be done. In the book, I talk about this in the conclusion, and I fully admit that it is the most superficial part of the book. I think that I kind of come to the conclusion that the most politically feasible approach, both in Brazil and certainly in the US as well, we're seeing a lot of resurgence of this, of regulating foreign investment, is not either the most effective way, because it is such a slippery category of the foreigner when you're talking about an investment fund. Yeah, it's challenging, and also because it just opens up so much potential for xenophobia and racism in implicit. The history of laws regulating foreign land ownership in the U.S. is pretty dark, and so I don't think that's the best approach. But there are, in the US, there's a history of anti-corporate farming laws, which were particularly put into place in previous land booms, especially the 1970s. A bunch of Midwestern states passed laws restricting corporate land ownership. Particularly, they would say only certain types of corporations could own land, and those were basically family farm corporations. So they have different ways of defining it. They'll say like at least one of the board or shareholders or whatever must live and work on the farm, or they have these different ways of defining it. Those laws have been very under attack recently. There's a thing called the Dormant Commerce Clause, which is basically, I'm going to mess it up, but it's basically saying that states can't kind of discriminate against trade from other states. And that's probably not exactly it, but basically it's been used to dismantle these laws on the grounds that it discriminates against landowners from other states. Like if you can only be a corporate landowner who is based in that state or, lives on the property, then it's discriminatory. But I think that, there have been law review articles written about ways that these could be kind of rejiggered, or certainly if it was just passed at the national level, there would be some potential there. I also just think governments all over the world, basically, I think there has to be a role for government in taking a more expansive view of the social function of land and choosing to incorporate that into rules around land ownership and expressly, think about expressly potentially putting limits on how much land can be owned by different types of actors expressly. I do think, and, talking about which kind of actors can own land. I think in the US, it's a bit of a pipe dream, but I would like to see that. Also, in the conclusion, I'm just like, Henry George, land value tax.
Should we stop there? Thanks so much, Madeleine. But let me start by thanking everyone who are here, the participants, for all the penetrating questions, also those who left. Of course, my two co-organizers, Sreya and Enrique, and not last but not least, Madeleine, thanks a lot for giving this inspiring talk and for answering all these questions. But really, I think we tried to push you in many different directions, but that was really, really interesting. Thanks so much. Before we finish, let me also say that our last webinar is next week, same time. We have Kamal Chauhan from IIT Kanpur in India talking on something totally different, conceptualizing bondedness and non-freedom, the case of Dalit women agricultural laborers in Western Uttar Pradesh. And so that is a postponed seminar, postponed due to our strike last week. And I hope to see some of you there. But for now, thanks to everyone, and thanks to you, Madeleine. Bye-bye.
Bye. Bye.
Bye.
Thanks, everyone.
Bye. Thanks a lot.
Yeah.
Okay, great. I'm just going to close the call then.